Thank you everybody for joining us. I know we have a few more people just logging on right now, but we're going to get started. So thank you very much for joining our quarter market update. So we're going to be focusing in on the last quarter of 2020. I'm joined here, as my dad mentioned, with my father and colleague, Peter, and as well as our other colleague, Adam. And really excited to be doing this webinar with both of you again today. I think we've done three of, this will be our third now in total for quarterly market updates, and we're going to keep this going throughout the year. We have a lot of really, really great presentations coming up this year, as well as, yeah, the quarterly market ones. So thanks so much for tuning in today. Before we get started, love to give an offer for anybody that would like to have a follow-up conversation from this webinar. Please feel free to reach out. We're posting a link in the chat box right now. This is a link to my calendar. So you can book a time that suits your schedule for a virtual conversation. Yeah, so if you're a client, love to chat, love to just have a catch up. If you're not a client, also would love to have a conversation as well. We welcome any feedback on these presentations and how we can improve them and give you more value. So without further ado, today we would really like to cover the last quarter market performance. What we're also going to do is try and make sense of what that means and how it can actually be applied to your portfolio and give some real examples in there.
Exactly. Very excited to share everything that we have today. Now, before we get into the meat and potatoes of the presentation, there are a couple housekeeping items we'd like to take care of. You should see on the bottom of your screen 3 icons: a Q&A icon, chat, and raise hand. So we'll be answering a few questions throughout the presentation as they come in. If you do have a question to pose to us, please click the Q&A and we'll do our best to answer it during the presentation. During the webinar, if you do have technical difficulties or your internet disconnects, please email me directly, adam@watsoninvestments.com, and I'll do my best to follow up with you with a recording of our webinar. With those items out of the way, let's get into it.
Well, as was said, we're going to be looking at a lot of sort of facts and figures about the last quarter of 2020. But before we do that, let's acknowledge the human aspect of investing. Now, we all do understand that stocks and investments are volatile. They go up and they go down. But so sometimes do the emotions of our clients. So if you own something and your portfolio goes up, you're kind of very optimistic and even elated, depending on how much it goes up. And then if there's a market correction, you can become nervous. And as we saw last March, when the world just fell apart with the stock market declining and the pandemic, there was fear. And then as markets go up, there's optimism. So I want to be mindful of the fact that investing is for the long term and that sometimes emotions do ebb and flow. If there's ever a time, anytime, if there's ever a time that you are nervous about your investments, please, that very day, give us a call, give me a call. We'd be happy to speak to you about that.
Exactly. And so much of investing is about your emotions. And one of those big emotions is fear, especially when the market is declining. So what we've tried to do here is show a quantitative view of fear by a measure of the volatility index. What this is essentially tries to predict the amount of volatility in the S&P 500 over the next 30 days. So over the last quarter, we see that the volatility expected to happen actually decreased about 17%, with a very noticeable spike right here in November, right during the elections. So what we're seeing is lots of uncertainty around the elections, which makes investors uncertain and fearful. So we saw that reflected in the volatility index. Let's keep that in mind when we're looking at the S&P 500 prices. Now, how did the S&P 500 perform over the last quarter? Well, it increased almost 12%, as we see here. So where the volatility decreased, we see the S&P 500 increasing quite substantially. In that same period of uncertainty or fear in the market, we saw that reflected in the prices as well, with the quarterly lows being during those election months. Very interesting to note the correlation between expected volatility and fear and the price of the S&P 500.
So our clients understand that we invest with one strong thing in mind, evidence. We are very clearly evidence-based investors. And let's look at some of the evidence that is used in our client's portfolio. But before we get into the specifics, in order to find some evidence that is compelling to be included, the logic has to be sensible. Does it make sense what the numbers are telling us? It has to be persistent. If we find something that makes sense over one time period, let's move to several different time periods to make sure that there's persistence in the same results. And also it must be pervasive. And what I mean by that is if something works in, say, the American market, does it work in the Canadian market? Does it work in Europe? Does it work around the world? And finally, let's look at the cost effectiveness. If there is something that is worth, if there's evidence that's worth building into a portfolio and it cannot be done on a cost effective basis, then it's really of no use to us. It has to be able to be implemented on a cost effective basis. So let's go over to the four main parts of this slide and look at the last best ideas that have come out of academic research. Back one slide. Come out of academic research over the last 60 years. There is a market premium. Now, what do we mean by a market premium? If you buy stocks, you will have a higher expected rate of return than if you buy bonds. And the reason for that is there's more risk in owning stocks. When there's downturns, the stocks can decline, typically more than bonds. So you do get a premium for owning stocks. Also, there's a premium for company size. Smaller companies have more risk, and therefore the expected rate of return on those more risky investments are higher. For example, if Walmart went to the bank for a loan, they would come out with a very attractive kind of Walmart loan. And let's say the same day some other firm, but a small firm, perhaps a startup, went to the bank for a loan, they're not going to get the same interest rate. The reason being is they have more risk in their company than Walmart does in theirs. So they're going to have to pay the banker a higher return. Same is true when you buy stock. If you're buying a Walmart kind of a stock, you're going to be happy with a lesser return. But if you're going to take more risk at buying a smaller company, you want a higher return. Now, the relative price, there's a lot of arithmetic, a lot of math in this one. So suffice to say that there are two types of companies that you can own. One is a value company and one is a growth company. Value, according to the logic and according to empirical data and the academic research, value companies do better over time. They have a higher expected rate of return. And finally, the most recent factor that comes into the dimensions of expected higher returns is profitability. If companies historically have been profitable, that profitability tends to continue. So let's look at how the premiums have worked in the last quarter of 2020. We'll be looking at large companies versus small companies starting in the Canadian market. Look how the large and small returns over just the last quarter were significantly different. Small caps did way, way better than large caps at 23%. Coming down to the US stocks, same thing, large companies versus small companies. Large companies did much poorer, small much better. And then finally, international stocks, that's only about a point better, 1% better for the small. So a bit of a photo finish, but nonetheless still remained strong. And the other point we're going to show you in this slide is growth versus value. I did mention earlier that value companies have a higher expected rate of return. What happened in the last quarter? Well, as you can see in Canada, the value at 15% far exceeded growth. Coming down to the US stocks, value again at 11%, far exceeded growth, with the same kind of value premium in international stocks. So what happens is we had basically a picture perfect quarter last quarter. That's not always the case. These returns aren't, when we're expecting higher returns, they don't always come every quarter, every year. Sometimes we have to wait. But the portfolios that the clients own are positioned to capture those returns when they occur.
Yes, so to Peter's point is that the returns in these premiums aren't always present. So what we're going to look at right now is over different 10-year periods of time, what has done better between value versus growth companies. And really what we see here is this entire part to the right, all of these positives are different time periods that represent that value companies outperform growth companies. So that is one of the tilts in the portfolio. So you do own growth companies with a higher concentration in value companies. Now, when we're looking at the academic research and actually what has proven to happen in the markets, we definitely want to be on this right side here, where we have a higher tilt, a higher probability of success in getting that, capturing that premium. On the left-hand side, what we see is these negative periods of time. What this is referring to is these are periods of time when growth companies have actually outperformed value companies. So the most recent 10-year period ending in 2019 is actually right here, and it's falling into the category where growth companies did outperform value companies. Again, wanting to just structure portfolios, tilting a little bit more heavily towards these premiums that overall we would expect to do better.
Well, as I mentioned, we are evidence-based investors. We tilt the portfolios that you own are tilted towards things that are expected to give you a higher rate of return. So what's the other alternative? The other alternative than investment is basically just buy what was good last year and seeing how that works. So let's go through some numbers. Over the previous 5-year period, if we can focus on the top left side of this screen, if you are going to buy a fund managed by somebody, you of course want to hire a good manager. So presumably you would limit your selection to the top quartile. So show me the results of who did the best in the last 5 years. I will pick my managers from the top quartile. Okay, fine. Let's see what happened in the next 5-year period. Now, again, you've only picked from the cream of the crop. So over the next 5 years, you've picked 25% of the managers. And of those managers that you selected from, only 21% of those managers remained in the top quartile. So if you had 100 managers that you were looking at to pick, only 5 of them are going to remain in the top quartile. Those are awful odds. Those are awful odds. That's not a good way to, that's not a good basis to have for an investment philosophy. Same thing happened with fixed income. You would look at the top quartile performing fixed income managers. 5 years later, same result. Basically about a quarter of them managed to stay there. So the fact that somebody did well last year, that doesn't really mean how they're going to do this year. Therefore, when you look at the evidence of investing, you look at what factors are in your favor, and then you stay invested in that manner. So when those premiums do occur, you're able to capture them. So this is perhaps my favorite. I would ask you not to look at any writing, not to look at any numbers on this. Look at this checkerboard, the different colored checkerboard. And we'll walk you through that with 2 examples. Look at the top left. There's a dark blue, purple type of color. What that figure represents is in the fourth quarter of 2016, on a quarterly basis, the best asset class of all the major 8 asset classes in the world was US stocks. So in terms of the logic of, well, I want to invest where the money is going to be made, if the US was the best place to have your money, then boom, let's put your money in that market. We'll look at on the checkerboard, again, forget the numbers, just look at the position, how that particular color-coded square bounces around, ebbs and flows. So the fact that the US was the top at the beginning of our numbers, our quarterly numbers, doesn't mean it's going to continue. And the one that's even next to it, more prevalent perhaps, is this mauve type of color. For 5 quarters in a row, emerging markets were the top performing asset class of the major 8 on the planet that we're looking at. So after 5 quarters, you got to start putting a fair ton of money into emerging markets because that's where the profit is. Well, look at the next 6 years on the bottom. Of those six quarters, 4 quarters, the emerging markets, which was the darling of just recently, is now in the doghouse. It's the very worst. So trying to pick based on what happened last year, there's no points in that. There's no upside in that. Now, to look at volatility, the way things investment-wise do bounce around, looking at the last quarter of 2020, look how it finished so strongly. And if you look at $1 investing at the start of this line, $1 investing approached about $1.20 by the end of the year. That's a pretty good year. But unfortunately, March happened, and that's when the pandemic struck. And there was all sorts of doom and gloom, and people were just wondering if investments were over as we knew it. That's just the way things happen. Now, let's look at the next slide and take a longer term perspective. Now, again, on the top right side, we see that lousy, magnificent, historic drop of March, followed by a historic recovery the next 30 days. And look how that, on a 10-year perspective, doesn't look so out of place. Anybody that's investing in equities knows that equities year to year, it's really, you don't know what's going to happen. The probability of you having a successful stock equity investment over a longer period is very, very much in your favor. And look how, although it was extreme last year, look how that decline in the spring of last year is very similar to other quarters and other years throughout the past decade. So basically, investment returns bounce around, have evidence-based investing, know what's going to give you a higher expected return, and then hold the course and let those returns materialize.
So what can you be doing? So what does everything we just talked about actually mean for you in your portfolio? Well, first, we're going to talk about rebalancing. So when we're looking at rebalancing a portfolio, we're speaking about when you have a specific asset allocation. And you should have an asset allocation. All of our clients, you do have one. It's outlined in your investment policy statement. It's something that is based on your specific goals and objectives and risk tolerance. And that asset allocation will change potentially over time based on your circumstances. So not what's happening to the market and to the world. Once you have that asset allocation, we're going to use as an example here, let's say it's 70% in equities is your money, and then 30% is in fixed income. Well, now when the market moves, we want to rebalance back to that target asset allocation. Rebalancing, as a real example, would be what we did in this past spring. So clients, you know this, we called you, we spoke about the fact that now that the market is down, we actually wanted to move some money from the fixed income, put it into the equity, which essentially did not change your risk tolerance at all, but just rebalanced your portfolio. What that allowed us to do was actually capitalize on the fact that there was volatility in the market. And for some of you even, we have even since taken some money off the table again. Again, it's always specific to your individual risk tolerance and objectives. Now, when we're looking at designing this asset allocation and that mixture between stocks and bonds, one of the considerations is the fact that we want it to be a better investment experience for you. So this next graph that we're going to look at, what this is highlighting is 2 different funds that we use in our portfolios. We're looking at the top line, which is one fixed income fund, and the bottom line, which is an equity fund. So these are the unit pricing of these funds over the past year. 1 year is a really, really short time period, but we thought that this was great to give a real example and really articulate kind of this philosophy and actually put it into a real example. So if you had a combination of equity and fixed income in your portfolio, your graph of what actually happened in your portfolio, excluding any rebalancing, inflows, outflows, would be some line that's kind of falling in between these two right now. So the fixed income helps to level out those returns. It also helps for if you are retired, that's where we're taking your retirement money. It is coming from the fixed income, because where would we want to take it from? Well, we'd rather take your income needs from the stable line where there's not a lot of movement versus having to sell anything when it's at a loss. So we don't want to be selling out of the market when it's at a loss. And I think just really keep in mind here that these two particular funds we're speaking about, and in terms of all rebalancing, they are very broadly diversified portfolios. So the equity is globally diversified, owning over 12,000 stocks. So that is how we're able to have this rebalancing. It is a completely different conversation if you were to own individual stocks. But again, 1 year, very short time frame. And we really want to be looking over a longer term perspective, but at least within 1 year, there is things to do in the portfolio that add a lot of value.
But clients might recognize parts of this slide. Now, this is our software, and what we do is we customize that for each client. So we have to look at what the client is trying to do. You're trying to invest your money to achieve your long-term objectives. Take, for example, retirement. During retirement, when the paycheck stops, you want to have enough money to continue with your lifestyle. So we take this software and we customize it to you. For example, we would look at any pension income that you have coming in, any RSP RIF money that will be coming in during retirement, and finally, spending money from your investment account outside of your RIF. And so we customize something based on how much cash you're expecting to spend every year, and consider this a quality control check to make sure you're going to be okay, to make sure that you're not going to run out of money during retirement. And so this allows us to do that quality control check, but it also allows individuals to customize what they might anticipate their retirement might look like. For example, let's say one of the couple has to move into a retirement facility before the other person has sold the house. You know, that is going to be extra expensive in the final years of life. What happens if there's a long period of time in a retirement? That can be factored in. So each client can customize, well, we can customize it on behalf of the client based on your objectives, based on the scenario you want to look at. We encourage clients to do this cash flow projection, quality control checkup every year. And virtually all of our clients take us up on that. It's a great process. It just makes sure that in the long term, regardless of the market going up or down, you spending more money or less money 1 year to the next, it is just an insurance that you, in the long term, are going to be okay.
So what else can you be doing? So we've talked this whole presentation about the investment portfolio, and that is very important. Having a well-managed portfolio is you have to have that. So, but you also need to have all those other components that go with the investment portfolio. So other things you need to be considering are things such as estate planning. Having a well-structured estate plan ends up saving a lot of money to your heirs. It can also provide for a lot of smoother transition and actually implementing your true wishes, which is really important. And tax planning. You have to have tax planning done in the account. So when we're designing overall portfolios, we're looking at what funds should sit into different types of investment accounts, what type of accounts should you actually own and have in your portfolio. And this really can be upwards of over 50% even in additional value. So every time we're managing accounts, it's the portfolio and that holistic approach, everything else that goes in it, because they must go together. We feel so strongly about that. We manage all of our portfolios with that approach. More things that you can be doing is really ensuring that you have a team approach. So working with a team is just safety in numbers. So if you have that team, there's that extra level of security than if you have just one individual person or maybe one person in your household that isn't responsible for the investments. And make sure you feel very comfortable to have open, honest communication with your advisor and the team. It is so important that you can speak your mind freely and really articulate what you want to achieve, and then make sure that the advisor is always going to help you make those decisions that are going to be in your best interest to achieve your goals. If you have a financial plan, it will provide a lot of peace of mind through extra times of volatility. It also is a higher chance of you maintaining and achieving your goals. So have that plan, relook at it, very important. Again, want to just remind everybody, please reach out to me. There's the link in the chat box to set up a meeting. Would really love to hear from you. Also, we have over 20 presentations this year. So some of these presentations are going to be just for our clients. Some of them are for groups that have asked us to speak, and then others are going to be open for anybody that would like to attend. So if you're on our email list, you will get invitations about our upcoming webinars. And also if you want to follow us on Instagram, Facebook, LinkedIn, and visit our YouTube channel, some really awesome resources there and great ways of staying connected. Our next webinar we have coming up is Grow Your Wealth. It is next Thursday. Peter and I are going to be presenting. It's only 20 minutes, so it's a really concentrated, focused webinar. It is designed for anybody that is still working and getting a T4 income slip. We are going to be having a webinar in the spring that focuses just on business owners. And this one is targeted for things that you really should be taking advantage of in January and February. So if this applies to you or somebody that you know, please feel free to email Adam. He's kindly offered up his email to send you a registration link. Thank you so much for joining us today. We really, really appreciate it. We are now up at the 30-minute mark. So thank you so much. And please give us any feedback to help us improve for our next quarterly market update.